Okay, for this video, I wanted to go over real estate depreciation recapture. So for the most part, I think people understand that when you depreciate real estate rental properties over the course of its life, you're lowering the cost basis in the asset, or your adjusted basis rather. So when you sell it at a later date, you might have to recapture some of that depreciation. But there is a lot of confusion about how to actually do that, and then what's the character of the gain? Is it ordinary? Is it long-term capital gain, short-term capital gain? What are the rules here? So I've got a few slides. We'll go over the rules and then a sample fact pattern. And then I've also got some sample returns here. So the real estate that we're going to be depreciating and then selling is in a real estate partnership LLC with two owners. So we're going to go over that, see how everything's reported on the K1s. And then we also have the two sample tax returns for each of the owners. So we've got John Q. Taxpayer here. He's a 50% owner. And then we've got Jane Smith, who's the other 50% owner. So we'll see how these numbers flow through to the returns and how they're going to be subject to different tax rates because each of those partners is in a different income tax bracket. So if we start here with the slides, just some basic background here. So when we have 1231 gains or losses, 1231 applies when we have property that was used in a trade or business, held for more than a year, and then sold. Now, I have a separate video on 1231 gains and losses, so you can go check that one out. But generally, the idea here is 1231 gives you the best of both worlds, right? So if you sell property that's 1231 at a gain, you get long-term capital gain treatment, which is nice because that's a lower rate. But if you sell it at a loss, you get ordinary loss, right? Now, what we're going to be looking at here is Section 1250. So Section 1250 is real estate, right? So this is going to govern the depreciation and the recapture rules for the sale of real estate. And the two different concepts that we're looking at here, and this is what I'm trying to clarify for a lot of, for a lot of my clients that sell, because they hear a lot of misinformation about what is 1250 recapture. There's two concepts. So the first one is Section 1250 recapture and then unrecaptured 1250 gains. Now, if you're reading that and you're thinking, well, that looks like it's exactly the same thing. There's no difference there. You just kind of jumbled up the words a bit. Well, that's fair. I do agree. I think it looks almost identical, but there really are different tax rules for these two different types of things. So on the next slide, let's go over what are some of those differences. So we start with Section 1250 recapture. This is depreciation recapture that is treated as ordinary income, and it's subject to ordinary income tax rates, period. Right? So there is no concept of it being capital gain at all in nature. So when do you have this 1250 recapture? This applies when you had real estate that was depreciated using a rate, an accelerated rate over the straight line method. Now, the reason why this is kind of a moot point, you don't really see it anymore, is because the accelerated depreciation methods for real estate hasn't been used in decades, right? So now when we put property into service, it's always going to be just use the straight line method. So if you had property that was placed into service, let's say in the early 80s, right, when these rules are still allowed, and you sell it, you might have some Section 1250 recapture, which is going to be ordinary, and that's the excess of the accelerated over what the straight line method would have been. And so where we would see that reported on the 4797 is this location here, right? So in Part 3, line 26, and then ultimately on Part 2, line 13. So if I jump over to the tax return really quick, we can see where that would live. So 4797 is where we report the sale of the property. And if we get down here into Part 3, this is where we're going to be working with this example, right? Because we don't have this Section 1250 recapture. But to the extent you did, you would see it reported down here in Section 26, right? So if this is Section 1250 property and you use straight line depreciation, then you just skip this section, right? Because you use straight line, you don't have any kind of Section 1250 recapture for those accelerated amounts. But to the extent you did, right, you would have the excess portion reported down here, and then it would be subject to tax as ordinary gain or loss, right? So we would have ordinary gain or loss amount on line 13. But in this case, Our example and most examples that we see to date don't have this issue, right? So that is Section 1250 recapture, ordinary income, ordinary tax rates, period. Now, here's where we get into what is more common, right? Unrecaptured Section 1250 gains. So unrecaptured Section 1250 gain is a component of the Section 1231 gain. So when we sell the real estate and we have this Section 1231 gain amount, what we're saying is that, okay, of that total Section 1231 gain, there is a piece that is Section 1250, right? That is the unrecaptured Section 1250 piece. That is the depreciation expense. Now, when we have unrecaptured Section 1250, the depreciation recapture is treated as a capital gain, but it's going to be subject to ordinary rates up to a maximum of 25%. The other thing that's interesting about this is if you have capital losses, those losses can offset the 1250 capital gains. Now, if we pause for a second here and think about this practically, how this is different. If we get up here, if we go back to the Section 1250 recapture, this is truly just ordinary gain, right? So it's not only ordinary income where you can't offset with other capital losses, right, because it's ordinary, but you would get ordinary income tax treatment and those ordinary tax rates up to the maximum whatever your marginal rate is. So if you're a high income taxpayer and you're in that 37% tax bracket, you're going to be paying 37% on those gains. Down here where we have unrecaptured Section 1250, you get that ordinary rate treatment, but it's capped at 25%. And that's what we're going to see with the examples with John and Jane is John is in a higher tax bracket, so he's going to get the maximum rate here while Jane will get the lower rate. Okay, so let's go to the third slide rather, and then we will talk about the fact pattern here. So here's our fact pattern. I'm going to run through the fact pattern first, then we'll look at the 1065 partnership return, and then the 1040s. So we've got John and Jane here own a rental property through an LLC. Now each person owns 50% of the LLC, so they're equal partners. And in 2021, they sold this property for $415,000. Now because they put the property into service in 2018, they're using straight line depreciation, right? So they have straight line method. There's no accelerated depreciation. So they're not going to have any 1250 recapture, but they will have unrecaptured Section 1250 gain, okay? Now the LLC bought this property for $350K in 2018. And then over the 3 years leading up to the sale, they claimed $37,274 in depreciation. And they incurred $2,274 as selling expenses as part of the sale. So we're going to see all these numbers on the 4797, right? I'll go over them once again. Now, after you consider the depreciation expense, the selling expenses, the adjusted basis of the property is $315,000, right? So that's how we got that amount, right? Our initial costs plus our selling expenses, and then subtract out the depreciation, which reduced our adjusted basis in the property. So the net gain at the partnership level is $100K. This $100,000 is the Section 1231 gain, and then remember, of the $100K, the component that is Section 1250 is $37,274, right? That's the depreciation. Okay, so now let's look at the 1065. We'll go over these numbers once again, and then we'll see how they show up on the K1s for the partners. So if I go back to the 1065, well, let's look at the 4797 here, right? We've got line 1A, gross proceeds from the sale, $415,000, and the details on the disposition are reported down here in Part 3, right? So we have Part 3, gain from the sale of property under 1245, which would be personal, 1250 is the real estate, right? So we've got our rental property here, date acquired, date sold, and then the sale information. So our gross sale price, cost basis, the depreciation, adjusted basis, and then there's our total gain, $100K. And that's being allocated 50% to each partner, right? Now, if we jump up to Schedule K for the 1065 here, this is where we report the totals, and then everything is being allocated across to the partners depending on whatever their ownership percentages are, right? So on line 10, we have our net 1231 gain. There's that $100,000 number, right? And then on line 9C, we report the component that is unrecaptured section 1250 gain, right? So there's the 37,274. That was the total depreciation that was taken on the property over the course of its life, right? So when we look at this number, it's very important to remember, right? The gain isn't adding the two together, right? The gain is still 100K, but a piece of it is the unrecaptured section 1250. And that's the important part here, because remember, $100,000 is going to be section 1231 gain. You get long-term capital gain treatment, but we have to be careful of the piece that is section 1250 gain, because that is taxed a little differently, right? Now, if we go look at the K1s, let's look at one K1 for John, and let's see how these numbers ultimately flow through to him. So we've got John's K1 here. Remember, he's a 50% partner. So on line 9C and 10, we could see his allocation of the net 1231 gain is 50K, right? And then his portion of that 50K, that is the unrecaptured section 1250 gain, is 18,673, all right? And then Jane's going to have a K1 that shows exactly the same amounts. Now, if we start to look at how these are reported on the 1040, let me jump over here. So this is the last slide, and then we'll look at each of their 1040. So each taxpayer, again, is being allocated 50K of 1231 gain, which includes their allocation of the unrecaptured 1250 gain, 18,637 each. The difference there is just pure long-term capital gain, okay? Now, here's the two fact patterns we've got for each taxpayer, and then we'll look at their 1040s. So Jane here, single filing taxpayer, she has W-2 income from her day job of 95K, and she's going to have 50,000 of 1231 gain on her 1040. Now, the long-term capital gain portion is going to be subject to 15% long-term capital gains rates given Jane's overall income, right? Remember, your long-term capital gains, it's anywhere between 0 and 20% depending on what your overall income tax bracket is. So what we're going to see here is Jane, she's getting a 15% rate for her long-term capital gains, but then John is going to have a different rate, right? So John, if we look at his return, he's got a W-2 salary of 600K, right? So John, his job just pays him that much more money, and so he's going to be in a much higher tax bracket. Now, he still gets the same 50,000 of 1231 gain. He's still getting the same 18,637 of unrecaptured 1250 gain, but they're going to be different applicable rates, right? Because these taxpayers, overall, their income is in much different tax brackets. So John's going to be paying a 20% capital gains tax rate on his allocation of the long-term piece. And then his section 1250 gain, because he's in this top marginal bracket, but because he's in the top marginal bracket, so he's going to hit this 25% amount. But again, remember, it's capped. So it's going to be capped at 25% on the unrecaptured 1250 portion. Okay, and then when we look at the overall effective rates for everybody, John's overall effective rate is going to be about 30%, and then Jane's is 18%. All right, so let's look at the returns, and then we can start kind of going through some of these numbers. So if we look at John's to start, right? So John Q taxpayer, right? So we've got a very simple return example here. We've got his wages. He's got no other investment income other than the allocation of capital gain or loss. So when we look at Schedule D first, the Schedule D reports the total amount of 1231 gain, right? So we see down here on line 11, gain from 4797, right? $50,000. That's the 1231 piece. And then on page 2 of the Schedule D in Part 3, he reports the unrecaptured Section 1250 gain. So he's got 18,637 of unrecaptured 1250 gain there. Now, if we look at, you have to look at the worksheets to really kind of compute what the tax rates are going to be on these varying amounts. So if you start with the Schedule D worksheet, it's a 2-page worksheet. I won't go over the entire thing because there are a lot of line items here, but I'm just going to highlight the pieces that are important to note. So when we look at the Schedule D worksheet, the starting point is always the taxable income. So that's your income minus your standard deduction or your itemized deductions. So in this case, John's taxable income is $637,450, and then down here on these two line items we could see the breakout, right? $50,000 of long-term capital gain. That's the 1231 piece. The unrecaptured portion is $18,637, and so the net amount that's being pulled out of there is that pure long-term piece, right? The $31,363. That is the portion of the 1231 gain that is truly just going to be long-term capital gain, okay? Now, the unrecaptured 1250 piece, the 18,637, that's the portion that remains in his ordinary income, right? Because remember, that piece, that unrecaptured piece, is subject to ordinary income tax rates, but it's going to be capped at 25% if you find yourself in that upper tax bracket echelon. So if we jump down to page 2 here, we can see how more of these numbers break out here, right? We have the long-term capital gain portion for John. There's that 31,363 number. And because his overall tax, his bracket, he's in that upper tier, he is paying a 20% tax rate on his 31,363. So the amount of tax on his long-term capital gains, this piece is $6,273. Notice this part of the worksheet up here, lines 31 and 32, 15% rate if you're in a lower bracket, and we'll see that's going to apply to Jane. And then on lines 35 through 40 here, we see the rest of it, the 18,637, that's the unrecaptured 1250. And then on line 40 here, we can see that John is going to be paying the maximum 25% on his 18,637. So when we isolate the 1231 gain for John, these are the tax pieces that he's paying on those amounts, right? So he's got the 31,363 subject to a 20% rate, and then his unrecaptured 1250 gain portion, 18,637, is subject to the maximum 25%. So if we go look at Jane's here, we'll see how the rates differ rather. So we've got Jane Smith, right? There's her W-2 income, $95,000, and she's got the same $50K of long-term capital gain, 1231, that's passing through to her. And she's also taking the standard deduction. So if we look at Schedule D, those same numbers, same exact numbers, right? $50K in gain, long-term gain flowing through from 4797, and then she's got her unrecaptured piece there of 18,637. Now, where you'll see the different computations is on the Schedule D worksheet. So we look at the Schedule D worksheet, right? There's her starting point for her taxable income. We've got the same breakout for the 1231 gains, right? The 50K in 1231 gain, the unrecaptured 1250 portion, 18,637. And so we take out the long-term capital gain and arriving at this line 14 number. Now, page 2, again, this is where we're going to see some variance, right? So the amount of long-term capital gain here that she's got, remember the same thing, 31,363, but given her tax bracket, she is paying 15% on that portion of the gain, right? Whereas John was down here paying 20. She's paying 15% on her 31,363. And then when we get down here to the unrecaptured 1250 portion, notice that the 18,637, the way this worksheet is figuring the amount for her is they are saying, look, given your total income amounts, the 18,637 is just going to be included in your ordinary taxable income, right? Whatever that effective rate is. We are not separately stating it down here and subjecting it to a maximum of 25%, right? Because her income overall doesn't put her into that realm where she needs to be paying 25% or capping the tax rate, right? So this is just going to be buried within her ordinary taxable income up here, and so she's going to pay whatever her effective rate is, which worked out to be about 18%. Okay, so I hope that was helpful, just kind of clarify this issue. Again, I think the key teaching point here, if we go back to this slide 2, this is the best way to think about Section 1250, right? You only have true Section 1250 recapture as ordinary income subject to ordinary tax rates up to whatever your top marginal rate is if you had depreciation that was being taken at an accelerated rate. If you don't have that, then you don't have any Section 1250 recapture. But everything else will be unrecaptured 1250 gains. And so you'll be working down here. And so the best way to think about unrecaptured Section 1250 is it's kind of a hybrid between capital gain treatment and ordinary treatment, right? Because remember, the 1250 piece is going to be subject to ordinary income tax rates, but it's capped at 25%. So if you're in a high income tax bracket, you know that, well, the maximum I'm going to pay on this is 25%. It won't be, let's say, a 37% effective rate. And then the other point that's really important to remember is it's still treated as a capital gain if you have other kind of capital losses. So if John had capital losses of, let's say, 100,000, he could offset the 1250 gains with those capital losses, and there wouldn't be any of this ordinary tax impact on the unrecaptured 1250 piece. So that's what's also very, very important to remember is you still get capital gain treatment for purposes of netting other losses. All right, so that covers it for this video. I hope that was helpful. Of course, if you have any questions, please leave me a comment below. Happy to answer and I can. And I look forward to seeing you again on the next video. All right, thank you. Bye.